Welcome to Solidarity Spotlight, the place where we share with you bleeding-edge stories in blockchain development. I'm your host, Solidarity. Today's landscape reveals a fascinating tapestry of innovation, challenge, and evolution across the blockchain ecosystem. We begin with market dynamics, where the cryptocurrency sector experienced a notable contraction, shedding 4% of its total value as major assets like Bitcoin and Ethereum faced downward pressure. Bitcoin's 0.3% dip to $109,029 and Ethereum's 0.9% retreat to $2,568 reflect broader investor caution, amplified by XRP's 4% slump and Solana's 3% slide testing the $140 support level. This pullback signals mounting apprehensions about macroeconomic indicators and liquidity, with total trading volume falling below $100 billion, suggesting a wait-and-see approach among institutional players. Such volatility could accelerate diversification into alternative blockchain projects as traders seek resilience, potentially benefiting Layer 1 solutions with robust utility narratives. Meanwhile, Robinhood's ambitious foray into Layer 2 blockchain infrastructure and stock tokenization marks a pivotal convergence of traditional finance and decentralized technology. Their strategy centers on monetizing block space by encouraging developers to build applications around tokenized assets, leveraging their recent acquisition of Bitstamp to enable 24/7 trading. This model threatens traditional exchanges like the NYSE by redirecting liquidity to blockchain rails, potentially eroding their fee-based revenue streams. Market impact could manifest as increased competition for user attention and capital, driving innovation in brokerage services while pressuring legacy financial institutions to adopt similar 24/7 frameworks or risk obsolescence. The emphasis on perpetual futures in the EU also positions Robinhood as a direct competitor to Coinbase's US offerings, which may intensify regulatory scrutiny as jurisdictions race to define derivatives oversight. Institutional participation remains robust despite market jitters, evidenced by Bitcoin ETFs absorbing $602 million in inflows on July 3rd alone, led by BlackRock and Fidelity. This renewed institutional confidence contrasts with Coinbase's Layer 2 solution Base, which suffered a dramatic reversal with $4.3 billion in net outflows this year through cross-chain bridges. The exodus highlights shifting capital allocation toward Ethereum, which enjoyed $8.5 billion in net inflows, reaffirming its dominance in smart contract ecosystems. This divergence suggests investors prioritize proven network effects during uncertainty, potentially widening the valuation gap between established Layer 1 chains and experimental scaling solutions. The outflow from Base may also reflect concerns about centralization risks in roll-up architectures, despite their revenue potential for operators like Coinbase. NFT markets exhibited paradoxical vitality, with sales volume surging 78% in Q2 2025, while trading value plummeted 45%. This reflects a steep 80% decline in average NFT prices, democratizing access but raising questions about asset devaluation. Art NFTs exemplified this trend, recording a 400% sales increase despite a 51% volume drop, indicating microtransactions are becoming mainstream. OpenSea bucked broader volume declines with a 156% sales surge, fueled by anticipation around its upcoming $SEA token. However, this growth coincides with escalating security failures, as Web3 lost $6.3 billion to hacks this quarter, a 215% quarterly spike, and one of the worst since FTX's collapse. Such vulnerabilities could accelerate regulatory intervention or spur migration toward platforms with enhanced custodial safeguards. Tokenization advances emerged globally, with Japan's Mina Bank launching a stablecoin pilot on Solana in collaboration with Fireblocks. Targeting cross-border payments and asset trading, the initiative explores Web3 wallets for daily banking, potentially accelerating real-world crypto adoption. Similarly, Ondo Finance and Pantera Capital unveiled a $250 million real-world asset investment initiative, expanding blockchain's foothold in traditional finance. These developments may pressure legacy banking systems to adopt blockchain interoperability or risk displacement, particularly in jurisdictions like Japan, where digital banking infrastructure is mature. Market implications include increased Solana ecosystem activity and heightened investor interest in RWA-focused tokens. Legislative momentum builds as U.S. lawmakers prepare for Crypto Week starting July 14th, aiming to fast-track bills like the Clarity Act for market structure and the Anti-CBDC Surveillance State Act. This coordinated push reflects growing political recognition of blockchain's economic significance, potentially unlocking institutional capital through regulatory clarity. However, quantum computing threats loom large, with researchers warning that 4 million Bitcoin are vulnerable to cryptographic compromise by quantum systems. Ethereum's proposed emergency hard fork for quantum resistance underscores existential risks, as migrating major blockchains could require months of downtime, a scenario that may drive near-term investment into quantum-resistant projects like QRL while suppressing long-term holds on vulnerable assets. Whale activity signaled strategic shifts, with a dormant Bitcoin wallet moving 10,000 BTC worth $1.09 billion after 14 years of inactivity. Simultaneously, 225 million XRP, $501 million, transferred from Uphold to an unknown wallet amid speculation about the SEC dropping its Ripple case appeal. Such movements could indicate accumulation by institutional entities or preparatory actions for corporate treasury management, potentially triggering short-term volatility as markets interpret intent. Chainlink whales mirrored this accumulation trend, amassing 85 million Link, the largest holding since 2022. Yet price stagnation persists, suggesting a supply-demand imbalance needing retail participation to resolve. Infrastructure innovations continued as a solo Bitcoin miner defied centralized mining pools, solving a block with minimal 2.3 petahash capacity to claim $350,000. This rarity highlights decentralization ideals, but also exposes the network's increasing reliance on industrial-scale operations. Concurrently, BVCI expanded its fintech footprint through a controlling acquisition of Luminous FX Corporation, signaling venture capital focus on synergistic blockchain fintech integrations. Such consolidations may herald a trend of vertical integration, where capital allocators prioritize full-stack financial service ecosystems. Token launches and unlocks introduced Micro-Volatility, with the Cross gaming token debuting on Binance Alpha alongside a 500-token airdrop targeting Web3 gaming interoperability. Conversely, Pi Network unlocked 18.6 million tokens, driving its price down 3.8% as supply overwhelmed demand. These events underscore the sensitivity of emerging tokens to emission schedules, which could incentivize more phased release mechanisms to stabilize prices. That concludes today's Spotlight. I would love to know your thoughts. Thanks for listening, and don't forget to follow me for more spotlights. See you next time.